The crash has already begun, not metaphorically, not as a warning. Right now, as you watch this, the Nasdaq has entered official correction territory, down more than 10% from its peak. The S&P 500 has broken below its 200-day moving average for the first time since 2025. All three major indices have now fallen for 4 consecutive weeks in a row. The last time the Dow Jones did that was 2023. Oil has crossed $100 per barrel again, and most of the people watching financial television right now are doing the one thing that will cost them everything. They are panicking. I am going to tell you exactly what is happening, why it is happening, what the mathematics of every major crash in history tells us about this moment, and most importantly, the specific things you must do right now, not to protect yourself from the market, to protect yourself from yourself. Because in 60 years of investing, I have never once seen the market ruin a patient person, but I have watched panic ruin thousands of brilliant ones. Let me tell you something that every person watching this needs to hear before they do anything else. Panic is not a strategy. It feels like one. When your portfolio is falling and the news is loud and your instinct is screaming at you to do something, that feeling is real. The urgency is real, but the action it is pushing you toward is almost always wrong. I have lived through 14 major market corrections. I have watched the Dow lose 89% in 1929. I have watched the Nasdaq lose 78% in 2000. I have watched the financial system nearly disintegrate in 2008. And every single time, without exception, the person who sat still and held their position ended up ahead of the person who sold at the bottom and waited for the all clear. The all clear never comes at the right time. It comes after the recovery is already over. And by then, the person who panicked has already missed the most important gains of the decade. I call this the panic premium, the invisible tax you pay every single time you let fear make a financial decision that math should be making. So let me walk you through the math. Let me explain exactly what is happening in this market right now and why it is not as surprising as the headlines want you to believe. Going into 2026, the S&P 500 had delivered 3 consecutive years of above-average returns. The Shiller-Cape ratio, the ratio that measures stock prices against a decade's worth of inflation-adjusted earnings, stood at nearly 40. The historical average for that number is 17. That means you were paying more than double the historical norm for every single dollar of earnings in this market. Robert Shiller at Yale University, who won the Nobel Prize in economics in part because of this research, demonstrated across more than a century of data that when this ratio climbs this high, markets do not need a specific event to correct. They correct because the mathematics demand it. They correct because the gap between price and value always closes, and it never closes gently. What you are watching right now is not a crash born of surprise. It is a correction born of arithmetic. Now let me explain the specific forces that are accelerating it. The conflict in the Middle East, now entering its 4th week without signs of resolution, has pushed oil back above $100 per barrel. That number matters more than most people understand. When the cost of energy rises, every single other cost in the economy rises with it. Shipping costs rise, manufacturing costs rise, transportation costs rise, food costs rise. And when costs rise across every sector simultaneously, corporate profit margins get compressed. When profit margins compress, earnings forecasts get revised downward. When earnings forecasts get revised downward, the price the market is willing to pay for those earnings falls. That is not panic. That is the mechanical repricing of assets in response to new information. The market is not broken. It is working exactly as it is supposed to work. The question is not whether this is happening. It is whether you understand it well enough to respond correctly. On top of the energy shock, we are in a period of continued elevated interest rates. The Federal Reserve held its rate steady at its most recent meeting. Inflation has not fully retreated to where central banks wanted it, and higher rates for longer means the same thing it has always meant. Borrowing is more expensive, growth is harder to finance, and the premium the market assigns to future earnings shrinks. When you combine a market that was already priced at twice its historical fair value with an energy shock that compresses margins and an interest rate environment that compresses valuations, you do not need a catastrophic event to trigger a significant correction. You need only for the assumptions that priced the market at those levels to quietly stop being true. That is what is happening right now. And the 4 consecutive weeks of declining indices are not the beginning of the story. They are the market finally acknowledging a story that the mathematics had been telling for months. Now, I want to teach you something that I believe is the most important lesson in the history of markets. I call it the recovery invariant. It is not a theory, it is a record. In 1907, following a banking panic that nearly collapsed the American financial system, the stock market fell nearly 50%. 4 years later, it had gained 193%. In 1929, the Great Depression arrived. Banks failed. Unemployment reached 25%. The Dow lost 89% of its value over 3 years. What followed was nearly 14 years of consistent growth, averaging more than 800% in gains. In 1973, Nixon removed the dollar from the gold standard. Inflation spiraled. The Federal Reserve raised interest rates aggressively, and the market lost 40% of its value. 3 years later, it had fully recovered, and the decade that followed produced gains that rewarded every patient investor who stayed. In 1987, on a single Monday in October, the Dow Jones Industrial Average lost 22% in a single trading day. Not a month, a single day. The panic was historic. The recovery was equally historic. The market went on to gain over 800% in the following 13 years. In 2000, the dot-com bubble collapsed, and the Nasdaq fell 78%. 5 years later, markets had recovered and were posting gains above 110%. In 2008, the global financial crisis hit. The stock market lost approximately 50% of its value. What followed was the longest bull market run in American history. And in 2020, markets fell 30% in weeks as the world shut down, before surging 120% over the following 5 years. Do you see the pattern? Every single time, without exception, the recovery came, and in most cases, it was larger than the crash that preceded it. I am not telling you this to make you feel comfortable. I am telling you this because comfort is not the goal. Understanding is the goal. The market has survived wars, pandemics, currency collapses, oil shocks, political crises, and financial frauds that nearly destroyed the entire system. And every single time, the person who understood that pattern and held their position came out ahead of the person who did not. The recovery invariant is not a guarantee about this specific moment. It is a statement about the architecture of markets over time, and that architecture has never once failed to reward the patient investor who respected it. So let me tell you specifically what you should be doing right now, and I am going to start with what you must not do, because in this environment, the wrong action is far more dangerous than no action at all. You must not sell in a panic. I know that is the simplest sentence in this entire video, and it is also the hardest to follow. But the data on panic selling is not ambiguous. Investors who attempt to time the market, who sell when it feels dangerous and wait to buy back at the bottom, almost always get it wrong in both directions. They sell too early and miss part of the fall. They miss the actual bottom. And then they buy back in after the recovery has already begun, which means they absorbed all of the downside and captured very little of the upside. Research tracking individual investor behavior across every major correction since World War II reaches the same conclusion every single time. The people who tried to be clever with their timing ended up with less money than the people who did nothing. This is not an argument for passivity. This is an argument for discipline. Discipline is not the same as doing nothing. Discipline is doing the right thing when everything inside you is screaming to do the wrong thing. What you must do is continue investing. I understand that this feels counterintuitive. When prices are falling, the natural instinct is to stop. But think about what falling prices actually mean for a long-term investor. They mean you are buying more shares for the same amount of money. Every $100 you invest today buys more ownership in American businesses than it did 6 months ago. If you have been investing $500 a month, invest $500 this month. If you have been investing $1,000 a month, invest $1,000 this month. The strategy called dollar cost averaging, investing a fixed amount at regular intervals regardless of market conditions, has outperformed market timing in every major historical study conducted across every major market over the past century. Not occasionally, consistently, always. The math works because you buy more when prices are low and less when prices are high, and the long-term average of your cost basis ends up below the long-term average of the market's return. This is not a secret. This is arithmetic. And right now, this market is giving you the opportunity to buy quality American businesses at prices that are meaningfully lower than they were 4 months ago. What you must also do is examine your actual exposure honestly. This is where I want to speak to you directly, the way I would speak to someone sitting across from me in Omaha. If this current correction, this 10 to 15% decline, is genuinely keeping you awake at night, that is not a market problem. That is an allocation problem. It means you are carrying more risk than your timeline and your temperament can actually support. If you are within 5 years of needing this money for retirement, for a home purchase, for a significant life expense, having the majority of it in equities at peak valuations was never appropriate for your situation. Not because markets were going to crash, but because you do not have the runway to absorb a prolonged correction without being forced to sell at the wrong moment. This is a good moment to look at that honestly and make adjustments based on your actual financial circumstances, not based on fear and not based on the noise. You must also protect the infrastructure of your financial life. During periods of economic stress and elevated market volatility, financial fraud and identity theft accelerate. People are anxious, distracted, and making more financial decisions online than usual. They are logging into brokerage accounts on public networks. They are clicking links in emails that promise insight into the crash. They are making decisions quickly because the sense of urgency the market creates short-circuits the careful attention that financial security requires. Use a VPN when accessing financial accounts remotely. Ensure every financial account has two-factor authentication enabled. Make certain your passwords are unique and not reused across platforms. These are not dramatic steps. They are the kind of quiet, unsexy protective measures that matter most when the environment is already chaotic. Now, I want to address something directly because I know there are people watching this who will say, "Warren, you warned about this market being overvalued before, and it kept going up. You held cash while the S&P delivered 24% in 2023. You reduced your Apple position and people thought you had lost your edge. You are right to raise that. Timing the market is not something I claim to do, and it is not something anyone can do consistently. What I can do, and what I have always done, is understand the difference between the price of an asset and the value of an asset. And when those two numbers diverge as dramatically as they did in this market, the direction of travel eventually corrects itself. Not on any specific date, not in any specific magnitude, but always. The market can remain irrational for longer than any one investor's patience, but it cannot remain irrational forever. The math does not have patience. The math simply waits, and then it wins. Berkshire Hathaway currently holds nearly $400 billion in cash and treasury bills. I did not build that position because I am afraid of markets. I built it because at a Shiller-Cape ratio of nearly 40, I could not find enough assets priced at their fair value to justify deploying capital. That is not pessimism. That is discipline. And that same discipline, the discipline of understanding value before price, of holding through volatility without surrendering to it, of investing consistently without letting the news cycle make your financial decisions. That same discipline is available to every single person watching this video. It does not require $400 billion. It requires only the understanding that the market's short-term mood and the market's long-term direction are two entirely different things. And the only people who have ever been permanently harmed by a market correction are the people who confuse the two. I want to leave you with something that I come back to again and again in moments like this. Imagine you are 85 years old. You are sitting somewhere quiet. The noise of this week, this month, this year, it is all behind you now. And you look back at this exact moment, March 2026, when the NASDAQ had entered correction territory, when oil had crossed $100, when 4 weeks of consecutive losses had the financial media in a sustained state of alarm. And you ask yourself one question, not, did the market recover? It did. The recovery invariant held, as it has always held. But what did you do in the middle of the noise? Did you sell at the bottom and spend years rebuilding what you surrendered in a moment of fear? Did you stop investing because the music had stopped and wait on the sidelines until it felt safe again, which was after the recovery was already finished? Or did you do the quiet, boring, deeply unglamorous thing that the mathematics has always rewarded? Did you hold? Did you keep investing? Did you trust the architecture of the market more than you trusted the volume of the fear? You have today. You have right now. You cannot buy back the gains you surrender by selling at the wrong time. You cannot recover the compounding years you lose by sitting on the sidelines. And no amount of clever market commentary, no analyst prediction, no financial media headline has ever been a more reliable guide to long-term wealth than the simple, patient, disciplined commitment to staying invested through the noise. The door to the cage is open. The cage in this case is the short-term thinking that the market's volatility is designed to provoke. It has always been open. You just have to be disciplined enough to walk out.